Crypto Hotep here with another investing video. If you're unfamiliar with this series that we have going on, we're on week number 9. Week 9. Trying to be consistent with my recordings here. And if you are, as I mentioned, if you are unfamiliar with the methodology and the thought behind these videos, feel free and watch week number 1, where I go through my whole process of this investment strategy that I developed with my family, how we pick the stocks, and what my process is currently. In a nutshell, my family, my wife, and kids, they selected stocks from companies that we placed in our M1 Finance brokerage account. Now, with M1 Finance, you can create specific pies that you can segment off. And this worked really well with this investment strategy because each pie essentially is a person in my family. And in their pie are those selective stocks that I mentioned. And here we just want to track our growth, track the investment journey with my family, and hopefully down the road, these videos will be helpful for them. Maybe they'll be helpful for you as well. And we are looking to build generational wealth as well. This is a small account, so we're looking to build this up as we go. And we just put a little money in there, a little extra money we have in there lying around. The main stock premise that I have are dividend stocks. My kids, as well as my wife, they don't all have dividend stocks. Some do have growth stocks as well. But with that being said, quick PSA, anything that we say in this video is not financial advice at all. Please do your due diligence. Please contact somebody professional if you're thinking about investing or trading in stocks, crypto, precious metals, any volatile assets. And with that being said, we'll jump right in here, guys. So week number 9. But as always, before we go to the current week's balance, we look at last week's balance. So last week, we were at $609. We did crack that $600 mark, which was fantastic. Our weighted return was about 1.63%. And then our dividends earned a little bit over $2. Here this week, we are looking at $625.85, which is a weighted return of over 6%. And the dividends, we are now at $2.34. So we're trending upwards. A lot of good happened within the week. We had a lot of strong earnings last week. And as you will see here, there's a lot of green to be had. Before we go in there, we'll go to the activity. Between this week and last week, we've had a little bit of dividend activity. Very nice here. So again, we're focusing, or this is a small account, so you can expect the dividend payouts to be small for right now. We're building. So here we have Lowe's, 3 cents, and John Deere, 4 cents. These both are in my portfolio here. So we have some dividend growth, if you will, in my stocks. So going back to the family portfolio here, we're going to jump right in and we'll go down the line here. So we do see a nice sea of green here. This is very welcoming to see because the last several weeks we've seen nothing but red. So it's good to see this. Our youngest still in the red with a weighted return negative over 2.5%. So let's see what's going on. So Nintendo's trying to claw back here. They were down, I believe it was over 12% last week. So now we've closed a little bit of the gap up, down a little bit over 10.5%. But here we've had an uptick in Apple now. Our youngest has had Apple, bought Apple not at the best price, and was distinctly red in Apple. Now we're starting to see an uptick in Apple, and that's the great thing about investing and then compounding that investment strategy as well. So still trying to purchase your investments, your stocks, even when you're in a downtrend, because eventually the markets will go up. I did see a tweet this week describing the market. And the markets are made to go up. They may not go up when you want them to go up, but they are made to go up. They may have a stall, they may have a correction, they may have a dip as well. But in the end, the market goes up. Just look at the S&P 500 chart for the past over 20 years. That's a distinct uptrend. Yeah, we're not saying that it's going to be a straight candle or straight couple, straight several green candles without any stopping. Not saying that at all, but if you're looking at more of long term, price distinctly goes up across the long term when it comes to investments and trading in assets. So Apple, obviously falling in suit with that. Tesla, we were still buying Tesla for our youngest, even during the small dip, not rather small, but the big dip that Tesla had. We were still buying it. And I mentioned, our youngest can obviously hold these volatile stocks. They have enough time to hold them. So, all in all, I feel good about that portfolio. And let's keep going down the line here with our middle, up over 2.5%. Very good. And let's see what we got here. Amazon. Amazon has been on a tear as of late, especially with the new AI news. So Amazon, again, a tech company. AI has been the driver for these tech stocks as of late. Amazon, it is a tech company. It is obviously shopping related, but they are funneling in AI with their strategy as well, and it's bolded. It's bolded really good for them. Costco. Costco up over 7.5%. Finally, if you've been following this rundown of these stocks, you'll know that our middle child has Costco. We've been in red for Costco, and I believe I said this last week that Costco was narrowing this gap of being negative. And I said maybe this week or next we'll see a reversal, and we are starting to see that in Costco. You love to see it. And then Nintendo, same as our youngest, down in Nintendo. Okay. Let's see my wife's stocks here. My wife's had a pretty good balance of stocks. I'm not gonna lie. This is a good trio of stocks. Celsius. My wife got a fantastic deal on Celsius. Just been building on it, up over 13% year to date. Very good. Here we also have Pepsi. Pepsi again, another great dividend, or not another, but a great dividend stock for her to hold. A fantastic brand, fantastic company, up over 8% here. And then Google, again, tech company, combining AI with their strategy. And Google is the king of search. Nothing's wrong with holding Google at all. So love to see this. Love to see my wife's stocks doing very well here. And then our oldest is in the top two. In the top two this week. Nice. So weighted rate of return, a little bit less than 0.5%. And our oldest keeps it simple, just the two stocks, Apple, McDonald's. McDonald's still down in the red, but again, Apple. This is why we continuously invest, and we kind of have cruise control on invest, so we can basically dollar cost average as price goes down, dollar cost average, because eventually it's gonna reverse and go back up. And these are companies that you don't mind holding. Apple's not going anywhere. McDonald's really isn't going anywhere. So all in all, very good sight to see here with our oldest stocks. And then my stocks here. So my stocks here, we have a weighted rate of return of 2.2%, dividends $2.30, and looking really good. Looking really good here. The only thing that's down, we have pharmaceutical. My assumption is that is J&J. Pfizer did have a little bit of a reversal this week and last week, which was good to see. J&J though just very surprisingly just gone down. Um, the technology stocks, as I mentioned, up over 1.5%. Industrials, I think I spoke about this maybe 3 weeks ago. Now that I said, hey, within the next coming weeks, industrials and energy are probably going to be the top performers in my portfolio just because of the way the economic shift was happening. There was that potential for that Middle Eastern conflict. So these usually shine. And as you can see, just remarkable. John Deere, over 10%, Chevron over 10.5%, Cintas over 10.5%, and Duke Energy over 9%. You're going to win if you have a portfolio with stocks that are generating double-digit returns like that. So very, very good over um, weighted rate of return for the industrials and energy sector, 7.5%. You can't beat that. And let's see what else we have here. We also have finance, restaurants, and food. I'll just touch very lightly on here because I am holding Starbucks. Starbucks down over 16 and a quarter percent here. Am I still buying Starbucks? I am. I'm still going to be buying Starbucks. I will still be buying Starbucks. Starbucks isn't going anywhere. I have faith in Starbucks. It's gonna be a rough patch for them. It will, until they can get a solid company plan from their CEO. It's gonna be a very, very rocky road for Starbucks, but they're not going anywhere. I don't mind holding that, and that right now they're paying the highest dividend that they've ever paid. Coca-Cola, the GOAT, as I like to call it, over 7% gain. Domino's Pizza, still on a tear. 15%. People love pizza. Texas Roadhouse, over 10%. Hershey Company, finally, over 3%. And McDonald's, very similarly to my oldest, we are down on McDonald's. And, I did mention the industrials energy before as one of the key players in this portfolio of mine here that I have. The other one was consumers and staples. It's kind of like just the steady Eddie, if you will, of stocks. Might not give you the double digit returns, but at the same time, you're not going to get a huge amount of losses with that. So, speaking of consumer staples, that kind of brings us to the stock that we want to quickly analyze here, and that's going to be the Clorox company. But before we do, just to recap, 625.85 current balance, weighted rate of return over 6%, dividends $2.34%, and we are on an uptick for the family portfolio. On to the Clorox company. The Clorox company, as we all know, is basically the cleaning company with Clorox wipes, Clorox disinfectants, those type of items. From an analyst perspective, they have it forecasted as a hold, or the consensus as a hold for the company. This is a dividend stock. It's one of my favorite dividend stocks. It's a very boring company, which I like a lot. They're not frill at all, but guess what? They are very consistent, and you can almost time their earnings. As you can see here from 2015, they've always been in the green except that one little blip on the chart here for 2022. But in 2023, they've regained that momentum that they have here. Okay, if we go to net income, the net income has had a negative growth in the past 3 years. Okay, so we've had a little dip in there. Let's go into the balance sheet though. So cash and cash equivalents, I like to see cash growing. Again, 2020, huge growth for them for obvious reasons. But we've still had growth in our cash and cash equivalents, over 100%, which is fantastic, especially when we were down over 42% in 2022. We can see their current debt. I do like to see the current debt decrease over time. We've seen that even though we've had the uptick in 2021, we've got a little bit under control for their debt, and now we have that we have that on the downswing as well. Retained earnings. Again, I like to see some positive numbers with retained earnings, and retained earnings is basically money lying around that companies aren't paying out in a dividend, but it can be used to put back into the company to better processes, better business development, those type of things. So we do have a positive number for that here. It is a little bit on the small side and has decreased since 2020, but this is still a positive number here. As I mentioned about debt growth, we are positive in the green for debt growth as well, in the negative, which is good. We talked about net income. Operating cash flow is in the positive here. And we talk about dividends. So currently we have a dividend yield of about 3.39%. Not a bad yield at all, right? The dividend growth, kind of small at 1.69%. And then their payout ratio is over 248%. Their dividend growth, though, is 47 years strong. That's another reason why I hold them so much, is because you know what you're going to get. You know what you're going to get with Clorox. And they just had earnings. Their earnings went along swimmingly. You can see here, they lift their annual profit forecast here for Clorox. You'd love to see that for a company. And if we can go, you can see here, we look at our dividend chart. This is what you like to see from a dividend perspective. Consistent growth for a dividend perspective. So this sits in my consumer staple section of my portfolio in M1 Finance. Again, I primarily got it for the dividend and the dividend yield, and because it is a company that has been around for ages, and because of the growth for dividend is almost half a century. Combining all those factors, I know what I'm going to get with Clorox. I like the company, like the stock. So with that being said, guys, I will close the video out here. If these videos have helped at all, feel free to comment, like, subscribe. Let me know what you want to see if I didn't cover anything. And as always, thank you and happy investing.